So today we are starting with the topic from the beginning, analyzing income statements. Okay. You know how to make an income statement, right? So the first question is about revenue recognition. How will you recognize revenue? So I will come out with the example what they have mentioned. First, when it comes to revenue, there are two types of revenue. One is cash, one is credit. We call it as cash sales, we call it as credit sales. So both we don't differentiate between cash and credit revenue in our income statement. When we make our income statement, we write revenue as a total figure of, let's say, 30,000 cash revenue and 70,000 credit revenue. So we write totally it as $100,000. Okay. We don't, categorize revenue in the income statement. But what we do with this two is, in case of cash revenue, your cash account will increase. Okay, your revenue. See the journal entry. What you pass is cash account debit. Okay, receivables account debit. Okay, to revenue or sales account. This is the journal entry for sales. Okay, so here it comes 30. This is also enhancing your revenue and enhancing cash account. See what is happening in case of cash revenue, your cash account is increasing. Okay, increase in asset is debit and also your revenue account is increasing. Just a second. And again, in case of credit revenue, your one more asset is increasing, that is receivables, and also your revenue is increasing by 70. So these two we put in debit and we put this in credit. So your revenue has increased by 100,000. We put it in income statement, SOPL or income statement, whatever you want, you can write. And these two assets are increasing simultaneously. So when you make SOFP, statement of financial position, what you do, this is asset side, liabilities and equity. You put cash 30, you put receivables 70. This is the treatment. Okay, so the first point is done. Now what they are saying in sale of goods, so what the first question is understood, describe general principles of revenue recognition. So I'll write some point here. Revenue is recognized when it is earned rather than received. Okay, so the point here is, in case of cash revenue, you get your money in your hands, but in case of credit revenue, you don't receive your money, but still you're earning, right? So since you're earning, you recognize that in the statement and you give you show that as a credit revenue or receivables in the balance sheet. Okay, that's what they're saying. So in sale of goods, where goods or services are exchanged for cash, of course, whenever you sell goods, you take cash, and returns are not allowed. So in sale of goods, where goods or services are exchanged for cash and returns are not allowed, the recognition of revenue is straightforward. It is recognized at the time of exchange. So when you really exchange the good with cash, you recognize the revenue. The recognition of revenue is not, however, dependent on receiving the cash payment. I told you right now, revenue is recognized when it is earned rather than received. Okay, so that's what they are giving a mention of. And whenever you have made some sales or revenue, whatever the returns you get, less sales returns, so you have to deduct this, and then whatever the net revenue comes, that is your actual revenue, what you recognize, and that too when you incur, when you earn rather than receive. The receipt, see, the receivables may make the payment. Let's say on 25th December, you made some credit sales on, see, January 1st you start your business, December 31st you close your books, December 25th you sold goods to customers, okay, and that particular sales is a credit sale. So that credit sale amount you may receive in the next year. That is in the year, this is 2024, maybe you may receive the money in 2025. So do you think you are not going to recognize the revenue? You are going to recognize the revenue, of course. Okay, because you will recognize the revenue since you are earning. It doesn't matter whether you receive the money in your hands or not. Receipt aspect can happen in the future later on. That's what they're saying. So the recognition of revenue is not, however, dependent on receiving cash payment. If the sales of goods is made on credit, revenue can be recognized at the time of sale, and an asset accounts receivable is created on the balance sheet, as I explained and mentioned to you. Because you need to show the revenue this year and you need to match the expenses with respect to that revenue this year to know the profits of this year. As a general rule, revenue is recognized in the period in which it is earned, which may not necessarily be the same as the period in which cash is collected from the customer. That cash can be collected next year, doesn't matter, but revenue is recognized this year because you have earned it. So revenue is reported net of any returns and allowances in the income statement. That is, example, estimated warranty provisions and customer discounts. So removing all this, after adjusting all these particular aspects, you recognize your net revenue in the income statement. Now, this point is fairly clear. Now we come to the next topic, that is unearned revenue, deferred revenue, or income received in advance. I hope the first para is very clear to you. Okay, you need to adjust the returns, any trade discount, it is happening immediately, you need to deduct there and then, and you should recognize your revenue. Any warranty provision is there, etc. Now, if payment for the goods is received before the transfer of goods or services, let's say this is a landlord. Give me a second, okay? Give me a second. Yes. So generally, whatever the revenue you record in the books, you know that if you have to reach to profit, you have to deduct all the expenses, or you need to match all the expenses with the revenue to know the profit of the current period. So revenue is reported net of any returns and allowances in the income statement. Example, you need to deduct all this also, okay, to show your revenue, net revenue. Fine. Next point. See, if payment for the goods is received, okay, from the transfer of goods. So I'm going to give you an example of the unearned revenue. So there's a landlord and there is a tenant. This tenant has paid this landlord. So let's say the landlord has fixed $10,000 as the rent for this tenant. Tenant has paid $1,20,000 or $120,000 to landlord in advance on Jan 1st. So this particular 1,20,000 to landlord is a liability. That liability is nothing but income received in advance. We can say this, we can say deferred revenue. We can say unearned revenue. Why so? Because landlord has an obligation towards the tenant. The obligation what landlord has towards tenant is to provide the rental service. So the rental service for the first month will end on Jan 31st. On that day, landlord can deduct 10,000, okay, from 120,000, okay, and recognize 1,000 as the revenue, okay, or income earned, okay, or rent received or whatever. And rest of the 1,10,000 is the unearned revenue or liability for the landlord. Okay. In this way, after entire 12 months have passed, the entire 1,20,000 will be recognized as revenue earned, and the liability in the balance sheet would be zero for 1,20,000 because the entire services have been provided and there is no obligation whatsoever the landlord has towards the tenant. Okay. This is the treatment. So if payment for goods is received from before the transfer of goods or services, a liability unearned revenue. So if you get the payment for the goods which you are supposed to sell to the customer, or advance payments, let's say, that creates an obligation from your side also, from the seller side. And if you are supposed to provide any service to any of the client or customer, then the advance payment what you get is an unearned revenue. The revenue, it will only convert into revenue when your obligation has been satisfied. So is created when cash is received. Offsetting the asset cash. So you get the money immediately, and that increases your cash account. Okay. And revenue is recognized as the goods are transferred to the buyer or you provide the service. As an example, consider a magazine subscription. When the subscription is purchased, an unearned revenue liability is created, and the magazine issues are delivered, revenue is recognized and the liability is decreased. So when you provide the service, your liability goes on decreasing. Now, converged standards under IFRS and US GAAP take a principles-based approach to revenue recognition issues. See, what happens is, as you know, the IFRS and US GAAP are going to converge. Okay, so they take a principle-based approach towards recognition of revenue. So they ask you to follow 5 steps to recognize some particular transaction as a revenue. What is that 5? What are those 5 principles of transaction? What are the 5 points? So the Converge standards identify a 5-step process for recognizing revenue. First and foremost point is there should be a contract between the seller and the buyer. Identify the contract with the customer. Okay. Second point, identify separate or distinct performance obligation in the contract. See, seller has sold the goods to buyer. Whether seller has also, charged for any separate services what seller wants to give to buyer, let's say repair and maintenance or servicing, etc. They have made a contract as per which the seller has to provide certain services to buyer for which the seller is charging money. Let's say you have bought a software from a software company, okay, and as per the contract, that means the contract between the seller and buyer is to sell the software, and also after buying the software every year there should be some updates or some overall something for which the seller is charging buyer. So that comes under separate performance obligation, distinct performance obligation, for which the seller will charge buyer the money. So since the seller is earning from the separate performance or distinct performance obligation, it is a revenue for them. Okay. So first you should identify the contract. Then if at all, apart from selling of goods or provision of services, whether they are charging for separate services, what they're giving apart from the natural sale contract, then determine the transaction price, because transaction price has to be either markup or margin. So the difference between this is markup is on cost, margin is on sales. So we will make an equation and understand what is that. So 100 plus 20, 120. So cost price, profit, Selling price, my cost price is 1 lakh. What is my selling price? So 1 lakh 20,000 into, oh, sorry, 120, sorry. This is markup, this is on cost. Okay, then margin. So 100 minus 20, 80. So selling price, profit, cost price. So this is your cost price. What is your selling price? So 1 lakh. So this is the way you frame the equation. For you get 1 lakh 25,000. Just calculate and see and make a note of this fast. I'll move forward. Just a second. Give me a second. So this is called your margin. Okay, so this is done. So transaction price can be calculated. And the next point comes is allocate the transaction price to performance obligations in the contract. See, whatever the money you are charging. So what happens is on how you are kind of, you know, allocate. What do you mean by allocation? Allocation is the amount belongs to a specific or particular task. So allocate the transaction price to performance obligation in the contract. Okay, so you need to see whether if you are charging $150, let's say, so for your sales, how much you are going to, show us the revenue. Let's say $130 for sales and $20 for maybe distinct performance obligation. So in this way, this 130 goes for the direct sale and 20 goes for distinct or separate performance obligation maybe. So this is kind of allocation of the transaction price for a particular service if you are providing, for which you are charging, and for particular good what you are selling to the customer. This is called allocation. What belongs to what you should put in that slot. Okay, and then finally, all things done, recognize revenue when or as the entity satisfies a performance obligation. That means when you have, when you have made a contract with the customer, when you already have mentioned if you are providing a distinct performance obligation, when you have, calculated the transaction price, when you have done the allocation of the transaction price for the performance obligation or for separate or distinct performance obligation, all things done, then you will be, collecting the money and providing the goods and passing all the risk and reward whatever in the good to the customer, and you will be fulfilling your performance or satisfying your performance obligation. You can recognize the revenue. That's it. So let's now understand all these points. Just a second. Please give a reading to these points which I have mentioned right now. I'll give you certain time and then we can go for a question and understand all these 5 points practically. I'm giving you a few minutes just, and we are about to wind up this section. Okay, then we'll go for expense recognition fast. So the points will give you certain details like performance obligation is promised to deliver a distinct good or service. Distinct good or service is one that meets the following criteria. Customer can benefit from the good or service on its own or combined with other resources that are readily available. So customers should benefit from the good for which they are ready to pay, or the service what you are going to provide them. Okay, or combined with other resources that are readily available. And the promise to transfer the good or service can be identified separately from any other promises. So you may make many promises, but the promise to transfer the good is the paramount one there under your performance obligation. Transaction price is the amount a firm expects to receive from a customer in exchange for transferring a good or service to customer. Transaction price is usually a fixed amount, but it can also be variable. See, either you may fix it or you may increase or decrease if it includes a bonus for early delivery. That means you have fixed a price of $100, but suddenly you are asking or demanding $20 extra for, early delivery or early delivery charges. Firm should recognize revenue only when it is highly probable that it will not have to reverse it. That means, suppose a student takes a, let's say you are going to take a subscription and immediately you don't like it and you're going to, ask for a refund. Then what? Then there is no probability that the admission or the subscription is going to be happening, right? So immediately if that happens, then it is not something which is kind of recognized as revenue. So a firm should recognize revenue only when it is highly probable, more than likely. That means more than 80-90% chances that it will not have to reverse it. That means it will not have to cancel it. For example, a firm may need to recognize a liability for a refund obligation if revenue from a sale cannot be estimated reliably. Firm recognizes revenue with the performance obligation is satisfied. So all these things have been done. The payment has to be received. And let's come to this. And here comes for long-term contracts, revenue is recognized based on firm's progress toward completing a performance obligation over a period of time. So, for example, what happens in construction contracts. Let's say you have booked a flat with a builder. First, they'll make the slab, okay, the basement, then first floor, second floor, third floor, fourth floor, fifth floor slabs. So every phase as they complete, percentage of work completed, they will incur certain expenses and they will ask some amount from you. Let's say they are charging 5 lakhs for slab, they have incurred an expense of 4.5 lakhs. Okay, so profit they made out of this transaction is 0.5 lakhs. This is the cost, this is the revenue, because the percentage of the work is like how much it is done, that much revenue they will recognize. And completely when the construction happens, totally the entire construction happens, the final payment what they take is the total revenue what they earn. They match their expenses with their revenue and know the profit from this transaction. Done. And all things are done. Yeah, a performance obligation is satisfied over a period of time if any of the following three criteria is met. The customer receives and benefits from the good or service over time as the supplier meets the obligations of the contract. Like that means you have provided a service or some kind of maintenance contracts you are giving, you are kind of making with your customer, and they are receiving the benefit from you either in form of good or service. The supplier enhances an existing asset or creates a new asset that customer controls over the period in which asset is created or enhanced. That means you are building something for your customer and giving them either a software, either a apartment. You are a builder and you make apartments, and you may make and deliver an asset for them which enhances their asset. Asset has no alternative use for the supplier and the supplier has the right to, that means it's inventory for them which they are going to sell. And example, constructing equipment specific to needs of specific customer, that means custom made, that also is revenue for you. The cost to secure a long-term contract such as sales commissions must be capitalized. So the cost to secure a long-term contract such as sales commissions must be capitalized. That is, the expense for these costs is spread over the life of the contract. That means whatever you give the commissions to the agents for selling the asset what you are constructing or making, you need to add that to the asset value because you need to recover that from the customers. That's the reason they add it to asset value. That's the reason they capitalize. So here are certain IFRS 15 deals with revenue recognition. This is the standard which deals with revenue recognition. Let us go for each and every concept here. Performance obligation and progress toward completion. Long-term contracts. A contract agrees to build a warehouse for a price of $10 million and estimates the total cost of construction at $8 million. So 10 million, they made a contract to build a warehouse, and the total cost of construction is 8 million, it seems. Although there are several identifiable components of the building, that means these all things can be seen in the building. These components are not separate deliverables. That means they will be going with the building only. And the performance obligation is the completed building. That means the whole building has to be completed. No customer is going to buy all this separately from you. They are going to take it with the building itself. So during the first year of construction, so they are giving it in phase wise. Okay, how the things are happening. The builder incurs 4 million of cost. Okay, that is 50% of the total estimated total cost of completion. So 50% of the cost they have incurred. Okay, first year. Based on this expenditure and I believe that percentage of cost incurred represents an appropriate measure of progress toward completing the performance obligation, the builder recognizes 5 million revenue. So I already told you the revenue is recognized based upon the percentage of completion of the work. So if the cost estimated is totally 8 million and 50% work is done, so you recognize 50% cost and accordingly you recognize 50% revenue and then you get 1 million of profit in this. Okay. During the second year of construction, the contractor incurred an additional $2 million in cost. Additional cost they incurred. Okay. So 4 million previously and 2 million now. Out of 8, 75% work is done. So 7.5 million out of 10 million will be recognized. And 7.5 okay. Because 5 million of the revenue has been recognized in the year 1, 2.5 of revenue will be recognized in the year 2 extra. This treatment is consistent with the percentage of completion method previously in use, although the new standards do not call it that. Okay, we'll see what they have not given any mention about new standards, what the new standards are following right now. So what is there in the syllabus, we are going to cover up that one. Maybe they have given the enhancement of this or update of this in the level 2. So let's go for the next question. Acting as an agent. Please go through this. So acting as an agent, you remember the chapter called consignment, which you have studied in your 10+2 days. Okay. So consider a travel agent. Let's say, okay, consignment also is something whereby you send the goods to the agent. They sell the goods to customers. They deduct their commission from that price what they receive, and they give back the money to the seller. That was in consignment. Let us see what the example these people are giving right now. Consider a travel agent who arranges a first class ticket for a customer flying to Singapore. Ticket price is $10,000 made by non-refundable payment at purchase. You know, right? When you book the flight tickets, it's not refundable at times, and the travel agent receives $1,000 commission on the sale. Because the travel agent is not responsible for providing the flight and bears no inventory or credit risk, they are acting as an agent. They are nowhere responsible. It is company's obligation towards the customer. The agent is just a mercantile agent. Because they are an agent rather than a principal, they should report revenue equal to their commission of $1,000. Yes, for the agent the revenue is $1,000. Okay, and the net amount of sale, if they are principal in the transaction, they would report revenue $1,000, the gross amount of sale, and the expense of 1,000 they deduct, and the net sales would be $9,000 for them. Okay. Note that while gross profit is the same, like $1,000 regardless of selling as a principal or agent. For agent, $1,000 is entirely the profit for them. But for the principal, like the sales value, the net sales for them is $9,000, deducting $1,000 of commission from 10,000. So for them, $1,000 is what they got, and when they divide it by 10,000 revenue, they still get 10% as gross profit, and gross profit amount is same for both the people. So if treated as principal, the margin would be 10%, but as an agent, it is 100%. Fine. Yeah, for the principal, it is 10%, but for the agent, 1,000 is their profit, 1,000 is their revenue. They make 100% out of it. Fine. Just have a look through this. Franchising and licensing. See, consider a fast food company that both operates restaurants and grants franchisee rights to operate restaurants under its brand name. That means if someone wants to run a restaurant for some X X company is running some they have some concept, okay, some particular food in which they excel, and you want to okay run a business not from not with your own concept, like you think that it will be a risky one. If you take a brand's franchise, it will be easy for you to run the business because the customers know about this brand, so they are going to give you the franchisee rights, okay, and under the license. So like they are going license is nothing but they are giving you a firm permission to run their outlets by signing the contract with them, okay, with by granting you some rights, and supplies franchisees with some products used in daily operations as well as charging a license fee. The company also receives a royalty fee of 2% of the franchisee's turnover. Accounting standards require revenue to be split into categories that have similar characteristics: nature, amounts, timing, and risk factors. The fast food company should put disaggregate revenue into three categories. That means aggregate is revenue, but they have to show in different ways. I said right, allocation of cost, etc., transaction price. So revenue from company-owned restaurants different, franchisee royalties and fees different, okay, and also revenue from supplies to franchises different. So franchisee fees often grant the franchisee the right to operate over numerous periods and would initially be treated as deferred revenue. What is deferred revenue? You already take the fees from those clients, right? And then you have to give the services to them. So since you have taken the money in advance from them, you and you are supposed to give, you are having an obligation to provide them services. You call it as a deferred revenue or unearned revenue or income received in advance. So subsequently it would be amortized to revenue. That means as you provide your services, your liability would reduce and your revenue would increase in the income statement over the life of the franchisee contract period. as the provision of services happen, you start recognizing it as a revenue. Okay. Service versus license. Now, royalty fees would be included periodically in the franchise's accounts when they become contractually payable by the franchisee under the terms of the contract. Simple. Service versus license. Consider a software. See, we take this antivirus softwares, right? There are some companies which give you antivirus softwares. So there is a software supplier that allows customers to purchase a license. That means you take a license, right, immediately and install the software on their own machines, or subscribe to cloud-based solution with access over the internet. So there is one thing, they are giving you a license to install a software, or they are giving you a service. They are giving you, asking you to subscribe to cloud-based solution with the help of internet. If customers purchase a license and install the software on their own systems, IFRS allows for two treatments. Software supplier will report revenue over the life of contract. Software criteria would be supplier will continue to update and enhance the software over the term of the license. So every time they will, as you have installed the software, you will get all the updates and everything under the contract. Okay. Contract under the term of license. Customer will be exposed to potential benefits or negative impacts from the updates and enhancements. And because see, sometimes the updates will be helping you. See, I have OnePlus phone. I don't want to take out any company's names. Sorry. It will be, against giving some examples, but some updates are not good for some devices, right? So I take back this particular thing. But some updates are not good at times. You are exposed to the negative impacts and as well as benefits, potential benefits. Updates and enhancements do not result in transfer of goods or services. So if any updates happen, any enhancement they do, this is not called a good or service for you. It is a part of the agreement. And second one is the software supplier will report revenue at the outset of the contract. License grants the customer the right to use software as it exists at the start of contract. That is, as immediately it is sold. Separate contract exists for enhancement sometimes and updates to software. They will charge money from you for updates. That is separate obligation. Okay, separate contract. If they are charging for that, they'll recognize that as a separate revenue. Bill and hold agreements, the last topic of this particular recognition criteria of revenue. Bill and hold agreements are a type of sales agreement that involves the customer paying for goods ahead of shipping. See, you did not, the seller has not shipped the goods yet. So the bill is generated, and bill and hold is nothing but the seller also has the possession of goods. Okay. The sales agreement has been made, the goods have to be delivered, but the goods are with the seller. Okay. And customer has made the payment. Typically, when a customer pays ahead of delivery, the revenue is treated as deferred. That means deferred and unearned has a small difference. Deferred means long term, short term liability it can create. Okay. So it is deferred revenue because they are having the obligation to give the goods to the customer. But revenue may be recorded before shipping if the supplier can demonstrate that its performance obligations are complete, and the supplier says that no, even though we are holding it, the risk and reward has been transferred and we are not nowhere responsible for anything, and now it belongs to you. If that is the case, they demonstrate, then what can happen? They can recognize it as a revenue. So customer pays ahead of delivery, the revenue is treated as deferred, but revenue may be recorded before shipping if the supplier can demonstrate that its performance obligations are complete. Customer has control over the good. IFRS criteria include the following. The customer asked for the arrangement. You have to check. Goods are identified as belonging to customer. You have to see. Goods are complete and ready for transfer. That should be the paramount thing. And the goods cannot be redirected to any other customer. That means once the good has been sold, that particular good with any item code or any indication cannot be sold to any third party. Okay, that is under the bill hold agreement. Required disclosures, see, everything whatever you write in the face of the statement you can show on the face of the statement, but what you cannot show on the face of the statement, you have to give the extra or additional information regarding that in the disclosure column. So what disclosures you should give under the converged standards include the following. So here the convergence is clearly seen. Both the US GAAP and IFRS are having lot of similarity in case of revenue treatment. Contracts with customers by category, you have to show extra information. Assets and liabilities related to contracts, including balances and changes. Outstanding, like if anything in any terms and conditions change, you have to mention. Outstanding performance obligation and transaction price allocated to them, that detail should be given. And management judgments used to determine the amount and timing of revenue recognition, including any changes to those judgments. Okay, so this part, management judgment is nothing but sometimes management has to judge. Judgment is required, like used to determine the amount, like how much amount and timing of revenue recognition when they have to recognize. Basically I have already explained you that revenue should be recognized when it is earned rather than received. Okay, and if at all they'll wait for a certain period of time or whatever, they have to mention that what kind of treatment they are giving. See, yesterday's question was not that complicated one. That was a fair easy one. I just looked into it. That asset turnover ratio, they are finding out based upon total asset turnover. They are including the cash and the asset, and the cash they have calculated already from the cash flow statements, taking into consideration the capitalization and expensing element. But that will take a long time right now. Tomorrow I have to go to Delhi. I'm leaving for Delhi for some 2 to 3 days. So I have my flight at 5 a.m. in the morning. So we will conclude today and we will take a fresh this particular topic, expense recognition, when I come on, like I'll be back on Wednesday. So I'll be, after coming I'll be free. So that day, whatever you say, I can stretch my good amount of time and finish expense recognition, which will be the last and final topic of this, and also this particular topic that day, the discussion what we had, this one, this calculation and this. So these two topics combined together, Wednesday would be the last session I will wind up. Okay, so taking this into consideration, I would look into it and I'll see tomorrow, Sunday, however, is a holiday, Monday and Tuesday, 3 days. If I can send 3 topics or 3 chapters as videos to you, I'll send it without wasting our time. You can go through that and wind up. Okay, so that after coming, I'll finish this. Then the status, what I look, and today I have given PDFs for solving. So this one is done. This one will be finished. Only 80% is done. 20% is left over. Balance sheets is done. Is it done? Balance sheets? Hello? Yeah. I gave the video topics, right? Cash flow is done. Analyzing of cash flow 2 done. Inventory done. Long-term assets done. This is leftover. This is leftover. This I'll give the video and you can finish this. That's what this I'll be giving you. And this one done. And this one done. Okay. So 3 topics, out of which 1 I'll be giving and going. 2 I'll be taking live sessions because crucial topics. So FSA, by the coming week, this entire book of FSA is done. You are ready for your revision. You can do all the questions which I have given you, and then I'll start conducting tests. Okay. Next topic after completion of FSA would be equity valuation. This one we will be doing. Okay. Thank you, all of you.